What if the market is completely focused on the wrong trades right now? Everyone is looking at the same three plays. Cheniere, Lockheed, Occidental. The producer, the contractor, the oil exposure. The crowd is already there. Those trades are understood. They are crowded. They are priced. But almost nobody is looking at what actually connects the entire system. The ships that carry the LNG. And the airline that explodes when fear reverses. What you are about to see is a two-position structure designed for one purpose. You win whether the Iran war lasts 3 more days, or 3 more months. This is not a guess. This is a probability-weighted setup built on how capital actually moves during conflict. Let's start with the core idea. Right now, the market is heavily positioned for one outcome. Higher oil. Long defense. Long producers. But that creates a blind spot. Because when everyone crowds into the same trade, they leave gaps. And this entire strategy sits inside that gap. Position 1. FLNG. The ship that carries what everyone is buying. Here's what is happening in the real world. LNG demand has exploded due to Middle East disruption. Traders are scrambling to move gas from the United States to Asia. But here is the problem. You cannot move LNG without ships. And right now, there are not enough ships. So what happens? Prices spike. Hard. Daily charter rates for LNG carriers went from $42,000 per day to $300,000 per day. In under 2 weeks. That is a 614% increase. Think about that in simple terms. If you owned a fleet of trucks, and suddenly the cost to rent those trucks went up 6 times overnight, your revenue would explode. That is exactly what is happening here. Now look at Flex LNG. They operate 13 LNG carriers. Not a massive fleet. But extremely valuable in this environment. And here is where it gets even stronger. They do not rely on spot pricing alone. They have 53 years of contracted backlog. Potentially 74 years. That means long-term, locked-in revenue. Now layer in timing. One of their ships, Flex Constellation, just entered a 15-year contract in March 2026. Right into the most aggressive LNG pricing environment we have ever seen. That means today's extreme pricing is not just temporary. It is being captured until long-term contracts. Now look at the stock. It is sitting around $30. Analyst targets? 23 to 25. Below the current price. And those targets were written before Qatar went offline. Before rates exploded. Before this entire shift happened. This is one of the rarest setups you will ever see. The fundamentals have already changed. But the market has not updated yet. When earnings hit, and those charter rates show up in real revenue, those outdated expectations get repriced fast. Now let's move to the second position. DOL. And this is where most people completely miss what is happening. Because they see one thing. Oil going up. And they assume airlines lose. But that is not the full picture. Delta is not a typical airline. They own their own refinery. So when fuel prices rise, they are not just paying more. They are also making money on refining. That offsets the pressure. Now add another layer. 60% of Delta's revenue is not even tied to basic ticket sales. It comes from premium travel, cargo, maintenance, and loyalty programs. That means their earnings are more resilient than people think. Now look at what the market has done. Airline stocks dropped 15 to 20% in the past month. Why? Fear. Higher oil. Lower demand. But here is the key. That fear is already priced in. Now look at the timing. April 6th is a diplomatic deadline. April 8th is Delta's earnings. 5 days apart. The market is positioned for bad news. But what happens if Delta reports and shows stable earnings? What happens if they hold guidance? That forces a repricing. Fast. This is not a long-term guess. This is a short-term timing edge. Now step back and look at the structure. This is not two random trades. This is a barbell. FLNG wins when oil is high and disruption continues. DOL wins when oil drops or fear reverses. So no matter what happens, one side is working. Let's walk through real scenarios. If the war extends 3 or more months, FLNG explodes higher. Because LNG demand and shipping rates stay elevated. DOL may struggle slightly. But the portfolio still wins. If there is a ceasefire in 4 to 8 weeks, FLNG still holds strength because LNG supply is structurally damaged. DOL rallies hard as oil drops and demand returns. Now both sides win. If there is rapid de-escalation before earnings, DOL surges 15 to 20% into earnings. FLNG still benefits from Q1 rate capture. Again, both sides can win together. The only real downside scenario is an instant, complete, and permanent fix to LNG supply disruption. Specifically Qatar. But engineering data confirms that cannot happen in under 3 years. That is the key. The downside is limited. The upside is asymmetric. Now look at probabilities. Base case, 50% probability, returns of roughly 22 to 35%. Bull case, 35% probability, returns of 38 to 58%. Bear case, 15% probability, down 5 to 12%. That is a favorable expected value. And that is how professionals think. Not in predictions, but in probabilities. Now here is the most important part. The market is currently doing what it always does. Oil goes up. And everyone chases oil. Everyone crowds into the same trades. But the real opportunity is not where everyone is looking. It is in what they are ignoring. The ships moving the energy. And the airline positioned for the reversal. That is the gap. That is the edge. And that is where this entire trade lives. This is legacy analysis.